All right, welcome back to another edition of Financial Accounting. So exam 5 is coming up here in a couple of days. You guys are going to be taking it at 2 o'clock this Friday. We'll go over some of the points you need to be reviewing for the sake of the exam. There is material available to help you start studying for the exam right now. We'll talk about those things. Next week, we'll jump into Chapter 10, but the homework won't be due for 10.1 and 10.2 until Thursday. So giving you the day Tuesday to get your accounting cycle extra credit project done. Now you don't need to do that. Of course, it's just additional points you can earn if you get 70%. So you need at least 70% in order to get some credit on the extra credit. This is a policy that we all are enforcing across all sections. So you can get upwards of 14 to 20 points. So if you get up to 95%, I'll just give you the full 20 points. Just realize that extra credit assignment is due next Tuesday at 11:59 p.m. So some people it's taking a long time to do it. Some people are making it through it pretty quickly. It just depends. So if you want those extra points, I recommend jumping in and plugging around with that. You need to get at least 70% on those. And also be aware the last day to drop the course is the day after. So hopefully by the time next Wednesday comes around, we'll have basically just the final exam and a few more homework assignments left over. You'll be able to determine where you stand with your projected course grade. If you want to talk with me about that, of course, my office hours are Tuesday, Thursday from noon to 4 o'clock. So let me know if those times work for you. Just jump in on those. You don't need to make an appointment. If you do want to make an appointment outside of office hours, tell me the days and times that work best for you. So without further ado, let's jump into the review. So I feel compelled to keep telling you guys about this because there's some people who are not following the Proctorio exam instructions as they should. So let's go through this again to make sure we're all on the same page. You need to make sure that Proctorio is working on your computer. There is a practice exam with Proctorio enabled on Blackboard. I recommend you at least try to go into that and start that practice exam to make sure Proctorio is set up correctly. Technological capabilities are your responsibility. No personal calculator is allowed. So there have been some cases where people had to get a 0 on their exam because they were using their own personal calculator. Realize it's any electronic device. That is part of the exam instructions when you go into your exam. You're not permitted to have any electronic devices on, in, or around you. So, I mean, if you have a pacemaker, that's fine. But just realize that we're enforcing that policy pretty strictly. There is an on-screen calculator, of course, as we've always had. You can use one blank page of scratch paper. That's a regular printout page, 8.5 by 11. You must label it page 1 on the front, page 2 on the back, and you've got to show it. So take the first 20 seconds of your exam and make sure that you're doing the following. Show your ID, scan your room slowly, scan your desktop, scan your scratch paper front and back, okay? Make sure you do those things because if you get dinged for not doing those things, we have to have an awkward conversation between you and I. So hang on to your scratch paper. After you've done your exam, it'll be a great way for us to sort of go over and talk about problems that cause you frustration. Same thing as before. You get 60 minutes, 21 questions. You can earn upwards of 105 points. There's no makeup exams except in cases of extreme emergencies. If you have any technological issues, realize there's nothing I can do about that. So again, make sure you try the practice exam with Proctorio before you start your actual exam. If you're running into any issues with accessing Proctorio, realize there's no password that's required. Okay, so if you're prompted for a password, realize that you don't need a password to start your exam. So if you're prompted, reboot your computer or refresh your browser or exit out of your browser, go back in. Okay, if you're still having trouble with that, contact Proctorio support. Okay. All material from your textbook is what is being tested on these exams. So that's why, at a very minimum, you got to read the book. I know some of you are not reading the book and you're realizing that should have been part of your studying efforts. So talk to me if you're still struggling with the course with regard to reading the textbook, the lecture notes, or any of the homeworks, okay? The material that we're covering is a little bit of Appendix F. There's about 5 questions. We'll talk about those here in a little bit, but there's no real accounting with Appendix F. It's just primarily just mathematical and conceptual questions that I ask you about. So 5 questions from there. Learning objectives 9.1 through 9.3 are what we cover for Chapter 9. So there's a bit of an equal, roughly equal smattering of those questions, 16 total. There's definitely journal entries, mathematical calculations. That tends to be the one that causes a lot of frustration for people. We'll talk about some examples here in a little bit and some conceptual ones. A lot of those conceptual questions tend to be what if scenarios. What if the market rate is higher than the stated rate? What's the effect on interest expense? Tips, recommendations, review all your homework. Make sure you ask yourself why the answers make sense. Focus on the processes, right? Sketch things out on scratch paper as you're going back and you're reviewing your homework. I recommend writing things out on scratch paper. Organizing the facts in a way that makes sense to you is key. Understand that this class is tough because I'm not just asking you for your knowledge or comprehension. I'm also asking you to analyze and apply the concept. So that's what, that's primarily the reason why there's so much work to be done in this class, is because what we test you on is not just your knowledge, it's how you apply the facts and the tools with the facts to get an answer. So make sure you understand the process. Memorization is not going to be enough for you. Review all your lecture notes, make sure they're all filled in. Additional practice is on My Accounting Lab. Let's go into My Accounting Lab. There is practice questions for exam 5 down there. Realize that the points you're earning in the class are based off of the homework assignments and this extra credit project. Other things like practice that are no credit, it looks like it affects your grade, but it doesn't. So if you're wondering whether or not any of these practice attempts affect your grade, they don't. Okay, they're just there for you. What determines your grade is the homework assignments. And so I take all your homework efforts, I multiply them by percentage points earned times 2, and that's what you see on Blackboard there. So my grades section on Blackboard will give you an update on where you stand in the class. Everything else, if you have a question about that, of course, just come in and see me. There are practice exams on Blackboard. Do them 2-3 times, maybe 4 times at the most, and then just to see how well you know how to work the material. If you're going in, there's some people who are doing these practice exams like 8, 10, 20 times. That's not it's not supposed to give you an indication of how well you know the material. How well you know the material is based on the work you've done up till now. So if you're having trouble still with certain concepts, you want to come and see me so I can help clarify things for you. When taking an exam, be mindful of your time, of course. This exam, I don't think too many people have difficulty with time. I think the one exam that was causing the most frustration for people was exam 3. So this one is similar to exam 4 in the sense that you either know it or you don't. But it's all multiple choice questions anyways. So at the very least, if you're not quite sure, select something. Okay? Dates are obviously important, but also just the details. So make sure you're watching out for the verbiage. If something says semi-annual, you have to do some calculations in a slightly different way than when it's on an annual basis. So pay attention to the little details. Sketch it out. Timelines obviously are helpful. In this particular exam, kind of like with a double declining balance method, it's helpful to sketch out a chart and do some math from left to right, row by row. Know any questions that cause you trouble, any thoughts you had for why you answered things. A lot of you guys are doing that and coming to talk to me about your justifications. And some of you are coming at me and saying, well, I came down to 2 answers and I wasn't quite sure. Some people are telling me that it's when they're not quite sure about an answer, they write down on their scratch paper the justification. And when they're writing out the justification, they realize, oops, this is the correct answer, not the one they selected. So oftentimes writing out your justifications to talk to me about can help sort of jog your memory about what the correct answer is. This is just a checkpoint, just like all the other midterms, right? And, some people, they do really well on this exam, but maybe not on, say, inventory. And some people are vice versa. So don't, beat yourself up if you've got, if you get a less than desirable score on this exam. Don't beat yourself up. Come and talk to me so we can sort of figure out what it was. A lot of times it's just about misreading a question, and that's how you miss points. But if you know it, let's talk about it. Exams are not do or die. I'm just trying to assess how well you know the material. Counting is not a verb. If the whole purpose of coming to class is to see how accounting is done in motion. So if I'm showing you how to shoot free throws with a basketball, then just realize that the purpose of your homework is for you to go take the basketball and practice free throws. So that's a key indicator of how well you do in the class, is how well you practice this material over and over again. Questions that students often miss on the exam cover the following. So one thing I will tell you, that in this particular list here, I'm sort of giving you indications of how I might ask questions on the exam. Whenever you're doing your studying and reviewing, you want to go through homework problems and ask yourself, okay, how might the professor ask me questions on an exam about this particular problem or this particular concept? That's just a tip that I learned a long time ago. I used it throughout my college career. So I'm giving you kind of like some, some indications on how to process that. What's the purpose of the discounted cash flows? Obviously, we know that future values tend to be a higher amount than present value. So the purpose of discounting is to take a known future amount and reduce it down to a current investment amount today. Which table to use on to discount future cash flows? Remember, we got single sums and we got annuities. Okay. Given present value excerpts. So I'm not going to give you tables. I don't like doing tables. It's just too much work to do that. It's also easy to make a mistake when you're using present value tables. So I'll just give you some excerpts on present value tables, and examples of excerpts are kind of what we did in class. It's also these items down below here. I'll give you present value of a single amount, or present value of an annuity, and I'll say, now go do some calculations with those. Pick which ones are the correct ones. Be able to calculate the present value of a single amount received at the maturity date, or after n years, assuming a rate of this. Calculate the present value of payments received annually. Those are annuities. Excuse me. Calculate the market price of the bond. Proceeds received from the issuance given the market rate is higher or lower than the stated rate. So a lot of those things we practice in class, those examples, I was just going to go back and sort of re-sketch those things out, make sure you can do those things on scratch paper. So market prices. How do we determine market price of bond? Well, we have bonds are funny in the sense that we've got both an annuity, the interest payments, and we've got a lump sum amount, the repayment of principal. So we got to calculate the present value of the face amount. That's a single lump sum amount. We got to calculate the present value of the interest payments, i.e. the annuity. We have to add those together to determine what is the market price, i.e. the proceeds we receive. So make sure you can do that, given that you have a certain selection of factors, present value factors to use. Which table data to use? So should we use the single amount or the annuity? I don't give you tables, but I'll ask you questions conceptually that, for instance, if we expect to receive a lump sum amount in the future, which table should we use? The present value of a single amount, present value of annuity, future value, whatever. Just be able to tell me, if you had to go access a present value table, which one would you use? You must know which present value factor to use. So again, like if I give you a listing of them, be able to apply the correct one to your calculations. Make sure you pay close attention to this. I can't stress this enough. Some problems people will say that interest is compounded semi-annually, or there are payments twice a year. Okay, that's basically the same thing. If there are semi-annual payments, or interest is compounded semi-annually, you need to take the rates, divide them by, take the number of years and multiply it by 2. That's a key thing that people tend to miss on the exam. So if it says semi-annual, take a step back and make sure you know which one you're using here. I think I made, this one should have been, should have said 10 right here. So I'll give you 5 and 6%. I'll give you 5 and 12%, or I'll give you 10 and 6%. So that's just an indication of saying, oh, do I need to do something with the semi-annual information? If I'm telling you that its number of years is 5, and the stated rate is, or the market rate's 12. But I say but you don't see anything in the problem about semi-annual or annual payments. You just have to assume by default that it's annual, okay? If it's annual, then your number of periods is 5 and your rate is 12, just exactly what I gave you. But if it says semi-annual, multiply that by 2, divide that rate by 2. Okay, so you get 10 and 6%. So I'll give you factors that are based off this or factors that are based off that. You just need to pay close attention. I usually don't try to mix it up, make it more complicated than it already is. So, so I've simplified it as much as possible, given the flexibility that I do have. Given that bonds were sold at a quoted price of something, how much was actually received from the bond issuance? What's the journal entry the company would, or the bond issuer would record? So if we're talking about at issuance, realize that we're always going to be getting, usually we get cash, but it's possible that we might get like a building or equipment or something like that. So I think maybe one of the questions may say, we got equipment in exchange for issuing bonds. The credit to bonds payable is always going to be based on the face value. So whatever the face is, you just want to plug that in there. So in the example that we had in our in class, we said face value of the bonds was 100,000, right? The cash is based off of whatever the price, quoted price was. So if it's say 96, that means 96% times the face, which in this case would be $96,000. The difference there being what? Some sort of debit's needed. So that's where you just plug in the 4,000. You would debit, in this case, discount. And the reason why it's a discount is because the amount we received is less than the amount we wanted. Face value represents our target, our goal of raising money. If we get an amount less, it means we had to discount the price. If we get more, it means we issued it at a premium. Bonds are issued at discount. You got to debit the discount. Bonds at the premium, credit the premium on bonds payable. How much interest is recorded on the first or second payments? How much of a bond discount premium is amortized in the first or second payment? So there's two different scenarios, straight line amortization versus the effective interest method. So in the straight line method, we calculate amortization by dividing the initial discount or the premium by the number of payments. So the straight line method tends to be the easiest one. So if you may recall this from the notes, we have bonds payable of 100,000. If we issued them at a discount, I think in class the discount amount was like is roughly about $7,000. So the total carrying value was 93 at the time we issued it. Okay, realize that the carrying value needs to be brought to 100,000. So the way we do that is by amortizing away the discount in this case. So we want to do some sort of credit until ultimately it goes down to 0, and all you're left with is the 100,000 of the bonds payable. How do I do this amortization? There's a couple different ways of doing it. I can use the straight line method, which tends to be the easiest way. If I got 7,000 as my discount, I want to divide it by the number of payments. And we said in class it was 5 years, a 5-year bond, and there were 2 payments. It was semi-annual. So there are 2 payments per year. So I multiply that by 2. Number of periods is 10. So it's the 7,000 is going to be amortized over 10 increments. So $700 a piece. So what that means is every time we make an interest payment, we're going to amortize 700, 700, 700 until we get down to the last one, 700. That's the amount of amortization of the discount. In the case of a straight line, again, this is the straight line method. When you're doing the journal entry, my recommendation is to sketch out what you know. There's always going to be some sort of debit to an interest expense. And there's going to be a credit to cash. The cool thing about this much is you already know right off the bat some of the information. So I could ask you questions of what is the interest expense for the first or second payment. In the case of straight line, it's always going to be the same. We know how much cash we are paying because it's based on the stated rate times the face. And then if it's, in this case, it is a semi-annual, so you want to divide it by 2. So we said in class it was $5,000. Now the $5,000 is always going to be how much cash we have to pay out based on the information we see in the problem. So if I say it's 10%, $100,000 note, then you can automatically calculate what the amount of cash we pay for interest is. But the interest expense may be different than that, especially if we issue it at a premium or discount. Here we know, because we've issued at a discount, we know how much to amortize away. And so my recommendation is to sketch out the T account so you can sort of see the flows. Where do I need to go over the life of the bond? I need to credit the discount account. So credit the discount based on the amortization. And this is going to be for, we said it was 700. So we know the amortization and we know how much cash we're paying out. So the question comes down to this: what's the interest expense? The interest expense in this case is just the plug figure. It's the whatever is needed to make that journal entry work. So in the case of a discount, I would say it's roughly about $5,700. Right? Be careful in problems like this just to make sure that you're doing the correct semi-annual or annual calculations. Okay? That's one way people tend to make a mistake, is they divide it by the wrong amount of periods. If it's semi-annual, in this case, it's 10. If it was just annual, we just divide it by 5 because we're only making an interest payment once per year, in which case the cash amount we paid out would be $10,000. So lots of different ways I can ask this question. Just need to be able to sketch it out confidently on scratch paper and just look and see what you have versus the 4 potential answers. So we've got that journal entry will be the same under the straight line method. That journal entry will be the same every single time we make an interest payment because the amortization is fixed, the cash payment is fixed, and therefore interest expense is going to be fixed. That's a situation where we have a discount. In the situation where we had, I believe it was the premium had 108, we sold that one for 108. So it was 108,000. Therefore, we had a premium, not a discount. Premium was $8,000. And these are the situations where we're paying people 10% annually. They're comfortable with some amount less. They're like, I'll just take 8%. So we look at that and say, well, crying out loud, you need to pay me more cash up front because I'm going to use this extra cash to help make those interest payments. If I have a premium, it starts off as a credit, and it means every time I amortize it, I need a debit, 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 etc. Under a straight line, how much is that debit? It's going to be the same amount each period. So it's not going to be 7,000, it's going to be 8 divided by 10. In that case, what do you get? It'll be 800. So 800, 800, 800 till it goes to 0. And eventually the total carrying value will go to 100,000. That's the goal. We're always trying to make it go to 100,000. If it starts off as a premium, carrying value decreases over time. If it starts off as a discount, carrying value increases over time. So 800 now is what I'm going to be using, but the journal entry is different, slightly different. The amount of cash is still going to be 5,000, but now we're saying, hold on, we need a debit to the premium account. And that's based off, that's the amortization that we're calculating. And so that amount here is now 800. So what do I need now as an interest expense to make this balance? I'm going to need 4,200. So that's how my journal entry works. And that's going to be the same regardless of whether it's going to be the same when we're using straight line method. It's different if we're using the effective interest method, which we'll talk about next. But that's the goal for the interest, determine the interest expense amount and what the journal entry should be. So practice just sketching those things out on notebook paper, and then you should be fine with the exam. I'll give you the straight up facts. The only, like I said, the key thing people tend to make a mistake on is how many periods they're actually dividing the premium or discount by. Most people get that there is a difference between cash received and the actual face value. So therefore you get a premium or discount. They get that, but they tend to read too hastily, and they make the mistake of calculating the incorrect amount of amortization. So don't let that be you. If we're talking now, not about the straight line method, we're actually talking about the effective interest method. You have to go do kind of like a schedule and go row by row. And I'm only going to ask you to go, like, say, 1 or 2 payments in. So in the case of the effective interest method, EIM, okay, you want to kind of create a chart where you say, okay, payment number, first one, beginning carrying value. So the beginning carrying value is 108. We want to ask ourselves, what's the interest expense? And here what we're doing is we're not plugging in interest expense last. Here we're actually determining what interest expense is based on what the beginning carrying value is. So we said that, and this is going to be based on the market rate. And the market rate in our example in class was, we said they wanted 8%. We said that is for an annual basis. On a semi-annual basis, divided that by 2, it's 4%. So the market rate we want to use is the rate divided by 2. Market rate is the key thing. The way people tend to make a mistake on the exam is they use the stated rate when they're doing these calculations. The interest expense is going to be based on the market rate. Okay? So the market rate, 4% times 108,000. Is 4320. The amount of cash that we actually pay out, the cash payment, is always the same. It's the 5,000. So the plug figure then becomes amortization. And that's just the difference between how much cash we're paying and what the interest expense is. So if you get this far, right, when you're doing this schedule, I recommend plugging in what you know. The interest expense, we know that based on the calculation, 4320. We know the cash amount. What's the plug that I need to make this journal entry balance? 680, which is the difference between interest expense I'm calculating the cash payment, or it's just the plug debit I need in that case. If I ask you to pay close attention to the dates in this case, I may ask you for the first payment or I may ask for the second payment. If you get this far, I recommend going another row. So figure out what the carrying value is at the end. It's going to be the 108, in this case, minus 680. So carrying value is going to go down over time. Then you start over again, 107,320. Multiply it by what? The market rate. Always using the market rate. Times 0.4, 4293. Also, I can ask questions about what's the interest expense doing over time? What is the carrying value doing over time? Is it increasing or decreasing? What's the amortization doing over time? If you calculate 2 rows of this, you'll see the pattern right off the bat. You can see that interest expense is decreasing over time versus the 5,000 cash payments. So I go back up here, erase this guy, plug in 4293. So we know that. So about 707. That's the plug right there, 707. Interest expense is decreasing, amortization is increasing, carrying value is decreasing, right? You do 2 rows of this. I ask you a conceptual question about it, you should be able to kind of just see the pattern. You only need 2 data points to figure out a trend. So once that goes through, what's the 107, 7320 goes down to now 106, 613. So writing things out helps me kind of curb my test anxiety. I recommend you just practice doing that. That's how we do the effective interest method. So EIM, the effective interest method, in the case of where we have a premium. If we have a discount, it's very similar, but you just want to be careful with the journal entry. One way people make a mistake on the exam is they mistake what debit or credit to do to the premium or discount account. So if we start off with, was it 93? That was a discount. In case of the discount, it was 7,000. And if we're using, we need to make sure that goes down little by little over time. So that means we need a credit every time we're doing this journal entry for interest. So credit, in this case, the discount, that's for the amortization. Amort. Okay, so I need a credit. So this is one thing, you just sketching out the journal entry. Take your time, make sure it makes sense. Okay. What is the amount of interest? We'll plug in the amortization after that. So again, we're using the market value, not the stated amount to determine interest expense. So 93 times 4%. Excuse me, not in this case. Under the situation, I should probably sketch this out on the side. If the stated is 10%, this is going to do this. This is something I recommend doing right before you do the exam, just sort of have this kind of visual in your mind. The market may be different. If the market is 12%, market wants more, so we're going to issue this thing at 93, which means we get an amount less than face value. If the market rate's 10%, that means we issue this thing at 100. That's issuing at par, get 100,000. If the market rate's 8%, means we have to pay them more money than they actually want. So they're going to have to pay us a little bit extra up front. So we'll say 108 or 108,000. That's kind of like a visual I recommend having in your mind. The prices and yields work in opposite directions. For you finance and accounting majors, you'll hear about that over and over again. The price, 93,000, is lower than the market rate. The price, 108, is higher than the market rate. It works in opposite directions. Because why? Because the market determines what investors actually want for interest. We are stuck legally based on whatever the stated rate is relative to that. Given that's the case, if the market rate, that was 8%, we're saying now that the market rate is on a discount, it's 12%, semi-annual means 6%. We use a 6% market rate. So take the 12%, divide it by 2 because it's semi-annual, 6%, multiply the 6% times 93,000. Cash payment's always the 5,000. What's the difference? Well, it's going to be 580. But again, I usually say, let me stop and plug it in, make sure it makes sense. 5580 debit, 5,000 credit. I need a 580 amortization. Now in this case, I need to bring the carrying value up to 100,000 over time. So take that 93,000, add the 580. Using the 2, obviously, I didn't need to do that. 580. So I have a higher amount of carrying value. Carrying value is going to increase over time. Interest expense will do what over time? Well, let's take a look. 93,580 times 0.06. This is 5,615. So interest expense is increasing over time versus $5,000 cash payment. 615 is the amortization. So interest expense is increasing over time. We see that because of the way the math works, we see amortization is also increasing over time. So 93,580 plus 615. It's up to 94, 195. So if the the amount by which we multiply the market rate, which is the carrying value. The carrying value is increasing over time, so interest expense is going to increase over time. So we got 5, 6, 1, 5. What happens to amortization? Well, based on the journal entry, it's going to be increasing over time as well. So mechanically, if you can write it out, you should be fine. Okay, go 1 to 2 payments in. I can ask you questions conceptually about how is interest expense changing over time? How is the cash payment changing over time? Hint, hint, it's not. How is the amortization changing over time? You just want to be careful, make sure that you know which direction it needs to go. Any questions about that sucker? I think that in terms of like the bulky part of the exam being from chapter 9, you can see from, what was it up above here, the questions. Yeah, 9.1 and 9.2. 9.1 was using the straight line method, and 9.2 is using the effective interest method. So you can see there's a lot of questions coming from those. Don't freak out about it. Like what we just walked through, if you can like be able to sketch out what we just did, given the facts on scratch paper, then you just want to make sure that you're reading carefully, and you should be fine for the exam. I'll give you enough of the facts. You just need to know what to do with them. So all these things I'm just sort of plugging in, like how could I possibly ask a question about this? Let's see here. What's the carrying value of the bonds? What's the journal entry recorded at maturity date? Generally speaking, we're always going to be debiting the bond payable account for the face value, 100,000. Credit the cash, 100,000. If there is any type of interest journal entry, we record that as well as a credit to cash for the interest, $5,000. And if we haven't accrued for it yet, we would just debit the interest expense and do the amortization of the bond premium discount. So just being able to kind of go through an example, I think just take our notes from class and just kind of boil them down in terms of just 3 scenarios: premium discount, and face value, or par, issuing a par. Then just kind of go through and just do the journal entries. One way to kind of see if I can organize this here. So we've got bonds issued at par value. What's the, oh God, what's the journal entry at issuance? It's the journal entry for interest. And then from interest, you can say, what is the straight line method versus the effective interest method? And then what's the maturity? What are the different journal entries? T accounts and journal entries tend to help kind of sort things out for us. And that's for par. And then you would want to do that same thing again for what if we have premium? What's the journal entry issuance? Where the interest payment, straight line, effective interest method, maturity. It's the discount. Any questions about that? You thumbs up out there if you guys are following along all right. Thank you, Cody, Jack, Zach, thank you. Good, people are paying attention. It's pretty tedious after a while, but I think it really can. The cool thing I would say about these types of topics is that fortunately people, it's just a matter of like, what do I do with the data? Right? Journal entries by now, I think people can get the pattern. It's just more about how do I sort this stuff out, practice writing it out. Let's see here. Okay. So some concept questions I might ask you. How are bonds reported on the balance sheet? Obviously, carrying value. If we've got a discount, we're netting the discount against the face value. We have a premium, we're adding the premium to the face value. But the overall carrying value is what we see on the balance sheet. How are discounts or premiums recorded in the ledger? Just kind of went through that example. Which interest rate stated or market determines the cash payment? That's going to be the stated interest expense. Of course, we know it's going to be based on the market. Will the market rate be higher or lower than the stated rate when bonds are issued at a premium? In the case of the premium, again, we saw a situation where market rate, and just think about an example like we worked through in class. have something you can anchor onto. If the market was 8% versus our 10%, we issued the bonds at the premium, we got $108,000. Case where it was a discount, the market wanted 12%, we're only giving them 10%. So I said, screw you. And they're like, no, no, no. We'll lower the price down to 93. Okay. Assuming the effective interest method of amortization is used, if the cash proceeds received at the bond issuance date are greater than the face value of the bonds, then we're talking about a situation of a premium. If it's a premium, then the question comes down to what market rate, was the market rate higher or lower than stated rate? Were the bonds issued at a premium or discount? Was the initial carrying value of the bonds higher or lower than face? What's the journal entry for the first or second payment? Will interest expense increase or decrease? These are all just the scenarios. Okay, so premium, this is the situation I believe we're talking about, greater than face, premium, proceeds, and this one was all discount. Just be able to answer these questions using an example. And if we're using the straight line method, just realize that the journal entries for the interest payments are all going to be the same. There's no change in the interest expense if we're using a straight line method. And am I going to ask these specific questions? Maybe in some way or another. I can't tell you for sure how it's phrased. It just sort of depends on the problems everyone gets. Not everyone gets the same problems, of course, in the exam. There's a pool of questions that we pull from. What are the various bond types? Serial bonds. We talked about, so some of the different types of bonds were mentioned in 9.1. So just go back and take a look at different bonds, 9.1. Characteristics that make them different. Some bonds are paid down little by little over time. Some bonds, you just make a bulk payment at the end. Some bonds are semi-annual payments, right? Serial bonds, etc. There's debenture bonds. Bond retirement. This was, I believe, 9.3. So the key thing here is when we're doing a journal entry, practice sketching it out. I think we gave a situation where we said the price, the call price or the retirement price, same thing. Be able to sketch out a journal entry. And the way to do that is figure out first the credit to cash based on the call price. So if we said that the call price was, say, 104, then automatically start plugging in the journal entry cash. Say it's the face value is 100,000. Then we know 104% of that is $104,000. So that when we retire bonds, we're always paying cash. It's always going to be a credit to cash based on the market price. What is the second part of that? So recall there's like a couple different steps we walk through in class. Step one, write out the cash. Step two, empty out the bond payable account and any associated premium or discount. So if we have the bonds, and let's say that when we issued them, the proceeds, the market price was, we'll say it was 108. So we issue these at a premium. That implies that there's some sort of premium balance that we have left over. So if we start off with 100,000 and we had a premium of 8,000, okay, that's to start. Now here's the key thing you need to realize. Where people tend to make a mistake on the exam is they use the wrong amount. They know the journal entry, but they use the wrong amount. When we initially issue these bonds, we may have gotten an extra $8,000 above what we wanted, but we have to ask ourselves, what is the current unamortized portion of the premium? So throughout the bond's life, we've been debiting. Now it's down to, let's say, the current unamortized portion, say now down to $4,000. Let's just say that, okay? So the carrying value is 104. We started off at 108, now it's down to, say, $104,000, okay? What is the journal entry at retirement? Well, first, we have to get rid of the empty out. Let me use red. We have to empty out the bond payable account. That's with a debit. That's based on the face value, so you know what that is right off the bat. It's going to be this 100,000. We're going to retire these things. We're going to get rid of them. So we need a debit of 100,000 there. So plug in 100,000. We're emptying out that account. We also have to say, what's the premium balance currently? In this case, the premium balance is 4,000. We need to empty that out because we're getting rid of the bonds to make that go to zero. So we need a debit of 4,000. Debit the premium for 4,000. If you can get this far, this is step 2 we talked about in class. If you can get this far, now the question comes down to, okay, do I have any gain or loss? It is possible that, see, in this case, we have a total debit of 104, and we have a total credit of 104. There's no gain or loss on this in this particular problem. So just because we retire bonds doesn't necessarily mean that we have a gain or loss on retirement. Typically, in reality, we do have a gain or loss. It just depends on how much we paid out in cash. How would this be different if we paid out, say, more money? Let's say that the call price was instead of 104, let's say the call price was 106. Multiply that times the face value of 100,000 means we have to pay out $106,000 when we get rid of this debt. So plug in 106. Now ask yourself, what do I need now, a debit or a credit? In this case, we need another debit to something, 2,000, and that makes the journal entry balance. The question is it a loss or a gain? So I think as you know, again, this is very similar to what we did when we sold our equipment. And I think some people made mistakes on this problem. They knew how to calculate the amounts, but they didn't know whether or not this 2,000 was a gain or loss. If it's a debit, it's a loss. Just like expenses and losses are both debits. If you've got a plug figure here for a debit, you know it's going to be a loss. It's a loss on the retirement. What if it's a credit? Well, credits are on the income statement are revenues. So gains are like that as well. Gains and revenues are both credits on the income statement side. So if we say retired this at, say, 102, and we paid out $102,000, plug in 102, and then ask yourself, what do I need to make this journal entry balance? I need another $2,000 credit. So that's going to be a gain. And that's the best way to sort of go through that and just mechanically plug that sucker in to figure out whether or not you get a gain or loss. Credits are gains, losses are debits. There were some questions that people were asking me about the practice exam. So realize I'm not sure how many questions I have about future value. Most of the questions about present value most of the questions about time value of money are present value questions. So here, assuming that the rate is 14%, lump sum $4,000 now, and investment in 9 years will be closest to what? So we know the present value, we don't know the future value. So in this case, we want to use, and this is about a lump sum, so we'll just ignore the annuity. Annuities are for payments. So $4,000 now will grow to what in 9 years? Find the, in this case it's 14, so find the 14 and then find the 9 years. And there's no semi-annual in this case. So I don't like giving you guys tables in the exam, but this is just a way to practice using the tables. Multiply this $4,000 now times 3.252. That's how you get that 13,000 right there. This is a situation where we're looking for future value, so we know it's going to grow higher to a higher value. In the case where we have this looks very similar, but it's different. Interest rate's 12%, present value. This is asking what is the present value of $8,000 received, and this is the key feature here, at the end of each year. So that implies payments, which means annuity. So you can get rid of just going to scratch this thing out. So we're just looking at the annuity table for 8 years. So what's the present value? So present value, I don't know. Let me get 8,000, 8,000, 8,000, 8,000. I have to discount all these things back. So I look at the annuity table for 12%, 8 years. What is that? Let's take 4.968, multiply it by $8,000 payments. Present value of that sucker, 39,744. So key thing you just want to look for, is it present value of a single amount or present value of an annuity? Present value of an annuity is like regularly scheduled payments. Okay, and I'll tell you which table to use. This one was using the straight line method. 300,000 is the face, 6% is the stated rate, 20 years is the term. Key thing you want to pay attention to is the semi-annual interest payments. If you see semi-annual, multiply this by 2, number of periods is 40. Take the stated rate, divide it by 2, so it's 3% every payment period. And then what do they tell us here? They don't tell us a market rate, which is fine, because we know that these things are issued at a premium. 330, so 300,000 is a face, 30,000 is a premium. I want to figure out the amortization on a straight line basis. Take that sucker, 30,000, and divide it by, this is kind of ridiculous, divide it by 40 payments, 40 periods there, and have 750. So sketch out the journal entry. When you ask about interest, the interest journal entry, you know there's going to be a credit to cash based on the stated rate, debit to interest expense, and some sort of amortization. So what's the 750, right? So I'm basically going to amortize this sucker 750 all the way till it gets to 0. So I need a debit to the premium. 750. Cash is 300,000 times 3% stated, $9,000. It's an ugly looking 9. And then figure out the plug. This would have to be 8250. And then when you're going through the journal entry, process of elimination works. You know the interest expenses can be different than cash. Get rid of that. Get rid of that. Cash is 9,000. That's good. Interest expense is going to be an amount that's lower in this case, so that's the second rate that we want. That's how I recommend doing that. So